tell me some more information. That's going to be called the balance sheet. Balance sheet is basically a list of what we own, which we'll call assets, and the things that we owe, which we'll call liabilities. So the balance sheet is kind of a big T, and we set it out with the assets on one side, the liabilities on the other, and then this thing called owner's equity, which is a little bit confusing. So we'll explain that in a sec. To give you an example, let's say you want $800 for a new iPhone. You've only got $600 in your bank account. So to make up the difference, your parents give you $200 as a loan, but they say you've got to pay it back by the end of the year. So what we've got is, what do you own? That's an asset. You own an iPhone. That's $800. But you actually have some liabilities. Liabilities are what we owe. You owe your parents $200. So I guess what we say is, well, how much do you own of the actual phone itself? Well, you don't own the full amount. We call that our owner's equity. That's the bit of the phone or the asset that's actually yours. That's going to be $600. And what we say is we can express this in what's called the accounting equation. This is so important. This is so basic and so important that if you do accounting, you'll understand this back to front. Your assets always equal your liabilities and your owner's equity. So looking at your iPhone, you had an $800 asset, a $200 liability, and a $600 of owner's equity. So it doesn't matter what the asset is, this is going to apply. Let's say, and hopefully you're going to buy a house, one day in the not too distant future. That's a $500,000 house. You've got $100,000 of your own money in the bank, so you're going to go and borrow $400,000. So we've got, how much do you own of the actual house? Well, that's going to be the part that's yours. That's the owner's equity part. That's yours. That's $100,000. You don't own the whole house, and the reason why is, although you've got an asset of $500,000, the bank actually owns $400,000 of it, which we call a liability. So what we do is we express that in our accounting equation. You've got a $500,000 asset, liabilities of $400,000, and owner's equity of $100,000. Over time, that's going to change. What's going to happen? You're going to pay back the loan. So this year you pay back $50,000. So the house is still worth $500,000, but now you only owe $350,000. Well, that doesn't balance now. We've got a fundamental problem here because I've got $500,000 on this side and $450,000 on that side. So what happens is, as you pay your debts off, your what's called equity in the house is going to go up. So that $100,000 should really change to $150,000. Another year goes by and you pay off $70,000. The house is still worth $500,000. How much do you owe the bank? Well, let's take another $70,000 out of that. You only owe $280,000. So that must mean your equity's gone up to $220,000, and together that equals. So that's basically how the accounting equation applies in your personal life, but that's a very basic example. How do people go broke then? We saw Enron. Enron had a great net profit. How do you go broke? Well, you basically go broke when your owner's equity is negative. Say I had assets of $100,000, but liabilities of $110,000. That must mean mathematically my owner's equity is negative $10,000. That is broke. Negative owner's equity basically means when your liabilities are more than your assets, you are broke. Well, how does that happen? No one plans to go broke. Let's say you go and buy a $900,000 house this time. You borrow $800,000 and you use $100,000 of your own money. So we've got a $900,000 asset, $800,000 liability, and $100,000 of owner's equity. Well, our example before was a bit basic. What if we kind of forgot one thing? What if there's a bit of a property crash and this value here changes? Because that's what happens with assets. The values go up and down. What if that went down to $600,000? Does the bank say, well, only pay us back $600,000? Absolutely not. They still want their $800,000 back. So what does that mean? That means you have got negative owner's equity. Now this is a very basic and a very extreme example, but that is broke. You have negative owner's equity. So let's look at another big business called Lehman Brothers, one of the biggest investment banks in the world. Here's their net profit leading up to the year 2007. That's $4.2 billion. That is a big company. I can't give you the figure for 2008 because they went bankrupt. So again, profit doesn't mean I can actually pay my bills. Why don't we look at another thing? Why don't we look at their assets then and go, well, maybe they didn't own much. Maybe they didn't have very many assets. Again, leading up to 2007, it's crazy. They own a lot of assets, so many that by the time they go broke, this number here is actually $691 billion. And the story doesn't make sense. A very profitable business with a lot of assets goes broke within 12 months. How does that happen? Well, why don't we look at something a little more interesting. Why don't for each of these years when we look at assets, why don't we look at liabilities? And now we see a bit of a story. Now we've got total assets of 247 billion, but we've nearly got as many liabilities. And every year we can see for Lehman Brothers, the liabilities basically covered pretty much all the assets. So by the end, we had $691 billion of assets, which is good, but we also had $669 billion of liabilities. Lehman Brothers' problem was in 2008, we had a little event called the GFC, and the value of this bar here went down. So if this goes down, property crash, for example, well, all of a sudden this bar is shorter than this bar, and we got a problem. By the time September 2008 came around, Lehman Brothers went bankrupt. They had total assets of 639. Okay, so the value of those assets went down. Well, what happens with your debts is not only do they, stay the same, they get bigger because banks charge interest. So they actually ended up with liabilities of $768 billion. That is broke. That is a negative owner's equity. Assets of 639, liabilities of 768. That's negative owner's equity of $139 billion. Pretty simple to understand. And look, it is a lot more complicated than that, but at fundamental basic understanding of accounting, you can see why this business went broke. Well, cash is real important. So cash is what pays the bills. How much cash did they have? When they went broke, they had $7.3 billion. That's good to know, right? How can you go broke with $7.3 billion? Well, there's many reasons, but $7 billion sounds good, but not when we look at it and go, hang on, we owe much more than that. So I think that's 1/100th of what we owe would be in cash. So that's